Hi everyone, I'm previewing the week ahead in financial markets and I've got my eye on the most traded financial contract in the world, the euro-dollar currency pair. US Treasury yields are continuing to rebound and that's supporting the US dollar. So I'll investigate whether the euro-dollar can hold on to the big 1.20 level, while also running through this week's economic calendar. GKFX Cambodia presents the week ahead. The euro-dollar pair topped out at 1.2350 in the first week of January this year after finding resistance from the January through April 2018 price range. Since then, it dipped back below 1.20 and a rising trend line, but managed a rebound to 1.2150, which has since petered out. So really, 1.20 is the big line in the sand. In my view, another drop below 1.20 opens a possible move back to the September and November lows near 1.16. But if it holds, the uptrend looks intact for another run at 1.2350 and then 1.25. By the way, if you're finding this useful, please do me a big favour and smash that like button, and the YouTube algorithm will make sure more people see this video. Okay, before I talk more about the euro-dollar pair and yields, let's have a quick run through of this week's economic calendar. We kick off with a People's Bank of China rate decision on Monday, followed by the German February IFO. There's UK unemployment and Eurozone inflation on Tuesday. The RBNZ are expected to hold rates steady in their meeting on Wednesday. Thursday, we have US durable goods orders for January, which, based on last week's retail sales, could see an upside surprise, followed by US GDP. Early Friday, we have inflation and retail sales data from Japan, and finally, US personal spending. Now, it's not the first time I've talked about the dollar and bond yields recently. In my January 18 video, I talked about higher yields as a reason the dollar Japanese yen might have bottomed when the price was around 103.50. Now it's above 106 and climbing. So why are yields important? Well, because the yield on government bonds represents what's known as the risk-free rate of return in the market. If you assume that the government will always be able to pay you back the money you invested into the bond, the return you earn on the bond has no risk. Economic growth is returning, but all the printed money is still in the system, which is leading to higher inflation expectations. Sometimes called break-even inflation, one measure of inflation expectations reached its highest in the US since 2014. If investors expect inflation, they will sell bonds that earn them a lower rate of return than the rate of inflation to avoid negative returns. As we know, when the price of a bond falls, the yield moves up. Forex traders look to park their money in the currency that has the most chance of seeing higher interest rates in the future. And right now, the bond market is telling us that that is in the US, where the best returns relative to the risk of default can be earned. And that's helping the dollar. Now, we always have to think about what the flip side of the story is. Higher yields have so far been good for the US dollar. However, if global yields start to catch up, which has already begun to some extent, then the dollar would be less in demand, and that would help the euro-dollar pair. Right, thanks everyone. Good luck trading this week, and make sure to subscribe so you don't miss the next episode of The Week Ahead.